Today at Petrochemical Strategies, show me the money. Let's talk about basic petrochemical economics, the impact of backward and forward integration, and implications of low oil prices on petrochemical profitability. It's April 14th in the year 2020. The heart of the petrochemicals industry is the steam cracker. There are other types of crackers like fluid catalytic cracking units or FCCUs, which are found in refineries, and of course nut crackers, but today we'll focus on steam crackers. So what does a cracker do? Well, whether it's a steam cracker, an FCCU, or a nut cracker, they essentially do the same thing. They take something that's not valuable on its own and they break it into smaller, more useful pieces. Like a nut cracker would take a walnut and break it into shell pieces and nut pieces. A steam cracker would take natural gas liquids and break them into petrochemicals called olefins. Now let's take a look at petrochemical economics. Economics are calculated with what are called vectors, which are a little bit like a balance sheet in the financial world. Here's an example of a generic vector. There are a couple key points to note. Inputs are always negative as they are consumed in the process. Outputs are always positive as they are what you get out of the process. And petrochemical vectors are calculated using mass, which means the sum of the inputs and outputs must be zero. In this example, I assume that we are putting in 100 units of mass into the process. My unit of mass in this case is tons. There are 5 product outputs, each of which contributes to the overall contribution margin. To calculate the overall contribution margin, you multiply the yield of each input and output by the price of that input or output. You can see this calculation in the right-hand column. I divided by 100 so that the margin is in dollars per ton and not dollars per 100 tons. The overall margin is simply the sum of the economic impact of each input and output, which you can see in the bottom right-hand corner of the chart. I went to the internet to get some generic yields for cracking natural gas liquids, which I'll use in the presentation today. Every cracker is different, but it is fair to say that cracking ethane will produce a lot of ethylene and a lot of fuel gas. This chart shows that for every 100 tons of ethane inputted, you'll make 15 tons of fuel, 80 tons of ethylene, with the rest of the mass being made up by propylene, butadiene, and other co-products. The prices and costs in the right-hand column represent recent market averages and not specific prices for any particular day. If you apply the calculation I just showed in the generic model to the ethane vector, you come up with a margin for cracking ethane at $112 per ton. The price of ethane is highly correlated to the price of natural gas. With the collapse in crude oil prices, I wanted to look at a feedstock that was correlated to crude oil prices, so I looked at natural gasoline. To be clear on terminology, natural gasoline is the C5 plus cut from a wet natural gas well. It is sometimes called field natural gasoline or light naphtha. Natural gas is methane. It is the lightest hydrocarbon known to man, and it is not used in petrochemicals cracking. Using the generic yields I mentioned earlier, I took a look at the economics for cracking natural gasoline. As you can see, the yields are significantly different from cracking ethane, with ethylene yields down to 30% and propylene yields significantly up to 15%. The other major difference is the amount of margin created by butadiene and co-products. These credits have a major impact on the overall contribution margin, which I calculated to be $106 per ton. I did the calculations for cracking propane and butane, the other major petrochemicals feedstocks, and came up with these margins. Based on my assumptions on yields and pricing, the conclusion is that butane cracking is favored over ethane, natural gasoline would be next, followed by propane. This is a very simplistic analysis. It doesn't take into consideration any operational or logistics constraints that a facility may face. However, it does give you an idea of what a petrochemicals complex would be thinking about when selecting feedstocks and going through site optimization. Also, it highlights the importance of having feed flexibility, meaning the ability to bring in all of the natural gas liquids versus just being an ethane cracker. Let's talk a little bit about forward and backward integration. There are several petrochemical companies who are backward integrated into refining. They have the advantage of being able to take the light ends from the refinery, the naphthas and the natural gas liquids, and upgrade them at the petrochemicals complex versus selling to the open market. While at the same time, they're able to take advantage of the middle distillate margins at the refinery. There's several companies who are forward integrated into downstream derivatives of ethylene and propylene. These companies have the advantage of being able to take much higher margins off of those downstream derivatives than they would be by selling the ethylene and propylene to the merchant market. There are three major takeaways from this section. Vector economics are very useful in feedstock selection. Flexible crackers look at the world differently than ethane crackers and can take advantage of higher co-product credits. Backward and forward integration makes a huge difference compared to a standalone merchant producer. So, what are the implications for low-priced oil on petrochemicals? By now, you've probably heard of the historic deal to stabilize global oil prices. This is part of an agreement between Russia and Saudi Arabia to cut back production by 10 million barrels per day in May and June, with future cuts to come. Some say this is not enough, citing that global demand loss due to the coronavirus pandemic is closer to 35 million barrels per day. If this is in fact true, we could be in a low-priced oil environment for quite some time. If this happens, ethane crackers in the US could lose their global competitive advantage. Naphtha crackers in Europe and Asia will become more competitive, thus reducing demand for cheap imports of polyethylene and polypropylene from the US. And petrochemical and derivative trade will become more regional. This will create an oversupply situation in the US. There are a lot of unknowns and things are changing very, very quickly. However, I hope that understanding how the money flows through the industry gives you a sense about where we are today and where we could end up sometime in the future. On that note, my next blog is going to be about the new normal, which I think you'll find very interesting. Thank you for watching today at Petrochemical Strategies. If you have a question, a comment, or would like to learn more, go to our website at petrochemicalstrategies.com and leave me a comment. I'd love to hear from you. Thank you and have a great day.